Welcome to the Real Estate Investors Roundtable. This is where we do real interviews with real investors that are active in the market today. I'm your host, Rob the House Guy, and this is the exact type of show I wish I had when I got started more than 2 decades ago to give me some of that inside information that can help propel you to the next level. I, for one, am very excited because we have a returning guest, a part 2, if you will. We have Oliver Austria here from Triumph Capital Partners. Welcome back.
Thank you.
And to anyone that missed part 1, we had you on here. We were talking all about your company and doing private capital and then institutional capital, where you came from. It was just a great episode. And I think we just felt that there just wasn't enough time to get everything out. And we wanted to have a part 2 now. And thank you so much for taking the time to come back on and do it again.
Yeah, this is fun.
So what we're going to talk about in this episode is the real estate financial climate, how it was back in the old Wild West, how it is today, and where we think it's going. Not just with private capital, but even the old institutional money and so forth. You'd mentioned before that you came from a banking background back in 2001, which was really the thick of it with all the subprime loans. What did you see back then as an underwriter?
Yeah, so it wasn't always like that. It wasn't always the Wild West. So what we refer to as the Wild West is when things started to get heated up. There was a lot of money in the system. There was a lot of desire and push to get home ownership up. So what happens is underwriting gets a little loose, gets a little crazy. Everyone starts to get loans that probably shouldn't be getting loans. And what happens there is that it pushes asset values up. So when you have a lot of liquidity in the system, it's going to push real estate values up. And ultimately, what happened was there was a downturn. There was a recession that was caused by real estate. And so the Wild West was teenagers, or maybe even just fresh out of school, no job, limited credit score, limited credit history, getting loans at 100% financing, sometimes 125% financing, on homes that were 7 figures, $1 million loans. It was a bit crazy. I'm happy to say that there was a correction that fixed a lot of that. And ultimately, there were things that took place that just like in any sort of correction, there's a cleaning out process, and that whole process cleaned up the banking system. Where fast forward to today, you have really qualified borrowers getting loans that are appropriate for their capabilities in repayment. So I know that ultimately things are kind of like a pendulum, right?
Yes.
Things are going to sway from one side, and it's probably a little extreme, and then it's going to go to the other side where credit was tight for a while, but it's starting to settle back in again, where things are pretty fair and normal.
Well, back in our parents' day, it used to be to buy a house, it was 20% down.
Right.
And you saved your money, you put your big down payment, and then you went and you got a home loan at your local corner bank. And in our generation, as we became adults, that was right at the beginning of, well, why put 20% down? Because that's only going to move your payment, a few $100 a month. Why don't we just go ahead and lend you 100% of that? And as it started driving things up, and then we quickly realized that people can't pay these back, especially when they have no skin in the game. When they didn't care about walking away from a signature versus walking away from $20,000 or $30,000 or $200,000 if they're buying that $1 million home. So now, fast forwarding from the crazy days when they recorrected, I personally, what I see is, I've seen FHA, which FHA, I always call it the new government-backed subprime. I see them getting looser and looser with their qualification process on that. But now, instead of the banks losing a bunch of money, now it's Uncle Sam losing all the money. What do you see with that in your market out in Cali?
Well, Cali's kind of a whole different market, isn't it? Visiting Cleveland for the first time, real estate values are way different. California, everything is expensive out there, especially if you're on the coast. FHA, is pretty forgiving in terms of criteria, but I think there's a time and place for an FHA loan, and if it were not for programs like that, um, especially in California, it would be pretty tough to get into your first home.
I know in our market here in Cleveland, Ohio, FHA is really probably the biggest game in town. If it weren't for FHA, I believe our housing market would slow down dramatically. But I mean, at least for the folks I see buying homes, it's rare that they're going to qualify for that conventional loan because they don't have the bigger money down. They don't have the perfect credit score. They may have had some bumps in the past, the bankruptcies, the foreclosures. So I think that it probably is propelling our market a lot right now. And I would be a little nervous to see what would happen if it dried up and got rid of that method of financing for your average homeowner.
I'd agree. I'd agree with that statement. Especially in California, as I mentioned, property values are so high that for anyone to come up with a significant down payment on $1 million home, which by the way is pretty standard, on the coast of California, Southern California, it's tough to come up with a meaningful down payment apart from what FHA would require. Now, with that said, I do think that there needs to be some protections in place to make sure that what we experienced pre-08 doesn't happen again. Because what was happening back then was anyone with a pulse was qualifying for a loan, and ultimately it screwed up the system. It got to a point where everybody was getting a loan that they shouldn't have gotten. Not everybody, but a lot of folks, and it messed them up for years and years to come. And it messed up, a lot of communities, and it's tough to rebound from that when you have, foreclosure or short sale on your record. Now, I think things are, starting to normalize again, and hopefully things don't start to swing to the other side of that pendulum again, where there's such loose credit because of so much liquidity in the market that things don't make sense from an underwriting standpoint.
Well, here's what doesn't make sense in my opinion. Is that we've basically, as business owners, we love the scale. You love the scale, I love the scale. We want to see how big can we get, how big of area can we cover, and that's basically what the banks have done. Yeah. And we've drugged the general public into our scale, our economy of scale. So we've gotten rid of the corner mom-pop banks where it was make sense lending, where the banker used to sit next to the borrower in church on Sundays, and they said, yeah, your score's a little low, but you're a good person. I understand you got laid off last year and you got back on your feet. We're going to make that loan. And we've turned everybody just into a number. Right. And then on the flip side, when things go bad, they're just a number there too. Take the house away. Don't work with them. Some of these loan modification and forbearances that they were trying to put in place for the homeowners to save the home, it would work on a local scale if it was a local lender, but when it became the large banks that were out west in New York, they just weren't working with the homeowners. And then they weren't really proactive in doing anything with the asset once they took it back. So they would be quick to remove the person from the house and then let this house sit there and get destroyed.
Yeah, it's a secondary market. It's the way that these properties are being financed these days. There's a huge secondary market in the mortgage industry, and what that means is that the local bank that originates your loan oftentimes is not the owner of that loan after the origination. And so, your local banker that you're going to church with, years ago, that person might have been the person that you speak to in the event that you hit hard times and you need to, figure out what to do. That local banker no longer has that loan anymore on their books, so they don't even have any discretion even if they wanted to help. So there's some pros and cons to this secondary market. It's created a lot of liquidity in the market where you now have so many people that can go out and get these loans, but at the same time it's created this disconnect in the relationship, in the banking relationship that you spoke of, which really is a thing of the past unless you have a local bank that keeps the loans on their balance sheet. Credit unions typically keep the loans on their balance sheet, and obviously private lenders. If you're looking for a loan for a home loan, there's sometimes private lenders that will make you a home on your primary residence. It's not common, but occasionally it happens.
Well, I know in our last episode, we were talking to you about your lending company. That's something that I love about that. When you're doing the fix and flip loans for investors, we're almost going back to Mayberry, back in Andy Griffith days, where you are that local banker. Even though you're in California and you're dealing on a national scale, you're still that relationship type banker that's looking at what makes sense and putting people beyond the number. You're like, does the whole deal litmus out? Does it make sense in a litmus test that this deal should work? And it's cool that you can still do that because you're doing business loans and lending to entities. But I believe that the big government regulations have made that impossible to do with trying to protect the consumer in just regular residential transactions for the owner occupants.
Absolutely. Yeah. Fortunately, we're in a space within the mortgage industry that hasn't seen a whole lot of regulation. Regulation's important for certain things like pollution and things like that. However, in our space where we have to move quickly, any sort of regulation that we would be, I guess, subject to would just slow down the process. And so if you have a deal that needs to close in a few days, imagine if there was a whole lot of regulation there that just, needs to, kind of take place. We're not looking at the same sort of turn times that we otherwise would. So we take pride in the fact that we take a consultative approach to these relationships with our borrowers. We allow a second set of eyes. We have a whole team that reviews these deals from soup to nuts. And if the deal makes sense, great, we'll provide financing for it. If the deal doesn't make sense, that's one deal that you shouldn't have done. That, sometimes the best deal that you do is the one that you don't do.
Oh, yeah.
So you know the saying.
Absolutely. Absolutely. And I always equate it to saying, in business loans for business purposes, like you're doing, it's kind of like two pro boxers being in the ring. There's not a lot of need for regulation. It's when that pro boxer steps out and starts fighting someone in the crowd. They're like, whoa, you got to slow down. Yeah, and that's the real problem. So we're going to stick in that arena for a minute and just talk about the business loans for business purposes. When you got started, you mentioned in the last episode, you were at Triumph Capital Partners, you were at 12, 14% interest, and now you're down to 8, 9. Do you equate that because the rates are dropping so low right now with the feds?
It's actually a function of how much money has been pumped into the system. We've experienced such inflows of capital that any prestigious private equity firm, any mid-level, bank has some exposure to the private lending industry in some way, shape, or form. You have so much capital chasing a finite number of deals that the interest rates only have one way to go, and that's to go lower. You combine that with an interest rate environment that has seen seen it only go down over the past couple of years. There was talk last year where interest rates might be going up this year. That never happened, and we're probably going to see rates tick down even lower than they are right now. Again, 14 and 15% just 9 years ago. We're talking about 8 to 10% now, possibly even lower moving forward. I see that as a reality. So I think it's boon time for real estate investors out there. If they can find the deal, they can be certain that they can get the financing as long as they have their ducks in a row.
So I think that's something that's important for people to know at home. Right now we're discussing an entire sub-economy that's never mentioned on any news channels, never mentioned on any financial reports in the Wall Street Journal or any place else about default rates or where the market's going. They're only talking about the institutional stuff, but they don't mention the private equity that's going on out there and how well it's doing and how great a returns. All the banks want to be a part of this because they know it's a sound, secure investment because of folks like you that have boots on the ground and make sense of underwriting to make this happen. And you have investors that have some skin in the game that are really driving forth to make sure that the loan gets paid back. None of that's mentioned. All they talk about is the gloom and doom of the foreclosure market. So with all that said, let me ask you, what is your default rate in your loans that you're doing?
We generally cap out at the state maximum. So we're, in California, we're 18%, but that's the most that we can charge. So depending on the we default to the max rate that a state would allow in that.
Okay, see, the fact that you misunderstood that question means that you probably have zero on default. I'm not talking about your default rate. I'm talking your rate of defaulted borrowers.
Oh, I see.
See, which is probably doesn't even cross your mind. Like, what do you mean defaulted borrowers?
Yeah, I mean, it just depends on how you define default, right? So we have some borrowers that, are slow payers. That's what we call them internally. And slow payers means, guy, has a payment due on October 1st. He's not paying it on October 1st. A lot of times you have these, small mom and pop, fix and flip shops that, are so busy, running the business that they're not necessarily cutting the check on the first of the month. Now, with that being said, we typically define default as 60 days beyond the maturity date. The due date. And so our default rate ranges anywhere from 5 to 10% depending on the time of the month.
5 to 10%. So out of that 5 to 10%, once they hit that 60-day mark, what percentage of those are unwilling to work with you to rectify the problem?
Just given most of our relationships, most are willing to work on things. Again, these are relationships that we generally have over a number of previous deals in the past. So if there's a reasonable issue that's taking place that we can help with, we'll certainly support them in however way we can. At the end of the day, if there's a borrower that just can't get out of their own way, then we're going to have to ultimately pursue going after the property. But we never want to get to that extreme. It's usually sorted out within, we have a whole asset management team in place that typically has follow-on relationships in terms of servicing and asset management with the borrower, so that it doesn't get too far beyond 60 days once it gets to that point.
So if I'm hearing you correctly, if you're talking about people that have had a real problem on this property, they're beyond 60 days, and they're unwilling to work anything out with you, that you have to aggressively try to take the property back, you're talking maybe a couple percent.
Yeah.
So compared to institutional loans, to say you have a 2% true default rate is almost like mind-boggling.
Yeah, I mean, you got to understand, Rob, that these guys have a vested interest in making sure that they get to the finish line, right? So not only have they put the down payment, not only have they put in the sweat equity in getting all the work done and getting this house turned into this beautiful project, but they also have this huge carrot that they typically are going to cash in on once the project is sold, right? So
Right.
They have every reason in the world to make sure that they get to the finish line, and we help them cross the finish line in the best way possible. So if there's additional time that they need, we'll typically work with them. If there's additional funds that they might need, we might modify the loan so that we can help them with that unforeseen expense that they didn't budget for at the outset of the project.
So you're on the journey with them.
Absolutely.
See, that you're going back to the 1950s again. that doesn't happen in institutional banking. But look how the difference between big regulations and make sense lending is working, because you're on that journey with them, and you both have a reason to make this work.
Yeah, this isn't a one and done transaction. These are all relationships with either the borrower themselves or the broker or any number of partners that we have in the space. So if we win, they win, and vice versa.
So you were clearly back in '01 getting started. You were doing underwriting for institutional loans in the subprime market. Why did you get into the private market? Did you see a big need for it, or just kind of fell into it?
There was a huge need for it. When I first started rehabbing homes, there were only a few options for where the money was coming from. There were friends and family. That's limited. There were a couple of private lenders in town. There was a great need for it, and I felt that just given my background and given my ability to scale a business like I've done in the past, I was able to do that in such a way where that was really a greater value add in my opinion, to the space than being a home flipper. And so I just focused on that.
Okay, so we've touched on the past. We went to where we are right now. Future, where do we see the future going for private money? Let's start with private money.
Yeah, I think a lot is going on in this market. We've been in a bull market since 2008, and the economy's fortunately been going pretty strong. Interest rates are dropping, and we're seeing an inverted yield curve again for the first time since 2007. So there's a lot of question marks. Interest rates are low. Inverted yield curve typically means that there's going to be, some recession at some point, not all the time, but that's been a reliable bellwether for the economy. And so, what does that mean? What is it all? I mean, it's a lot to digest, but for the for the individual, in the business of flipping homes or building up a real estate portfolio, it means try not to get too caught up in these macro events. It means continue to do what you're doing. Don't get too scared by what's going on with the headlines. Understand, that you're going to have ups and downs in the market, and just make sure that you're not trying to get in the business of timing the highs and the lows of any market. And so, if you see a deal in your local market that seems to be a discount off what you could otherwise see another property sell for, then you should probably think about looking at the deal as another investment. I mean, nothing changes. It's we must go on, right?
When folks at home, when they're watching the media and they're hearing about the market falling, and just being timely that today is like one of the big drops of a few hundred points, I think that, in my opinion, that's an opportunity to say, awesome, people are getting scared. People are going to be dumping rental properties. People might be getting out of some real estate investments. And then to be aligned with someone like you that's like, hey, not only can you go out and buy stuff on sale, we're here to finance that stuff on sale. Because really, in the worst of times, where the most fortunes are made.
Absolutely.
And to have a finance company aligned with that forward-thinking process, that they're not running to the hills like a lot of the institutional banks are, is just amazing. So I don't know if all the experienced and inexperienced folks at home watching this understand, but this is a pretty cool thing.
As they say, when there's blood on the streets, there's money to be made. And
yes.
So that simply means that there's opportunities that come along when the market falls. I mean, since 2010, since I've been in the space of lending money to real estate investors, the business has been strong. So in 2010, as you remember, the real estate market was kind of in a lull, across the country. I would say that that's one of the busiest times that we've ever had. So in a time where it's been a down market, we've been super busy. It's been an up market for the past few years, we've been super busy. And so we've been able to see investors, small and large, make money regardless of the market. So, to your point, if you stick to your to your knittings, and you kind of realize that there's opportunities to be made regardless of what the headlines are, then I think you'll do well for yourself.
Well, I know you're a Cali guy, from Boston to Cali, so you only live in expensive places, apparently. But being in the Cleveland real estate market for 22 years, I don't think we ever saw that dip like the rest of the country did, because we're buying things so far below replacement cost. I mean, to replace a house that, we might be selling a two-family house. A lot of my investors come from Cali, and I might sell them a two-family house for $30,000, $40,000. It's bringing in $1,100, $1,200 a month. And that's unheard of, because if that house were to burn to the ground, you could never rebuild it for $30,000, $40,000. It would cost you $150,000 to rebuild it. So I believe the future here is pretty solid. I think it's still continuing to go in the trend of more cash buyers. Where when I got started, I was selling to a lot of buyers that were borrowing money from institutions. Now, I'd probably say 9 out of 10 of my buyers are either writing a check, or they're going to someone like yourself that's funding that transaction for them. And I don't see it slowing down regardless of what the economy is doing.
Right. Yeah. It's a magical space that we're in to be real estate investors. And, whether the market's good or bad, I think there's an opportunity somewhere. Look in your own backyard first. But, what I mentioned earlier, you could take your knowledge and apply it anywhere across the country.
Yeah, absolutely. Now, in the last episode, I asked you what freedoms real estate has given you and your family. But I'm not going to be redundant and ask the same question again. So what freedoms do you see your clients getting from real estate? All the folks coming to you to borrow this money to make their dreams come true. What freedoms do you see them getting out of this?
Sure. I've seen a lot of amazing things via real estate investing. The thing I love about it is that everybody kind of has their own, particular goals and, strategies to it. I've seen folks develop, a huge portfolio of properties over a short number of years and never really have to have an active daily schedule as it relates to quote unquote work anymore. They love it and they continue to build upon those portfolios. Some folks that are in the real estate investing space that have more of a creative kind of bent to them, allow them to kind of have an outlet for that creativity while still being able to build and amass income. So from the standpoint of designing your life, I find that a lot of folks have been able to accomplish just that, get away from what would otherwise be considered a daily grind, a corporate grind, whatever that might be, and it's an amazing time to be alive, to be able to not only be a part of the space, but also have all the tools in front of us to be able to do this anywhere. And so whether your thing is cars, houses, traveling, that's all possible through real estate. I mean, real estate, as we know, is the number one wealth builder in this country. And for anyone to be able to just pick it up and not have to go to college for it, not have to go through extensive schooling through it, but still be able to find avenues for education and support system and a community around it, I think that's an amazing thing. And you don't find that in every space or industry.
And as a shameless plug for you, and have that rich uncle that's willing to fund the dreams. Oliver, thanks so much for being on again. I know you and I could talk forever about this. We should have a third episode. No, I'm kidding. It's been great, though. We love having you on here. You've been watching the Real Estate Investors Roundtable with your host, Rob the House Guy. And remember, nothing works unless you do.